Hello and welcome to the Global View on this Wednesday. Let's take a look at the macro picture. US Treasury yields trading in a narrow range as investors await inflation data to be released tomorrow. That's ahead of the Fed's next policy meeting, where we're increasingly being priced in a rate pause. The consumer price index is expected to show core month-on-month inflation up 0.2% in August, the same as the previous month, and slowing to 4.3% on an annual basis. In the latest data from the US, small business sentiment fell last month for the first time since April on concerns over inflation and the difficulty in finding labour. The two-year Treasury yield edging back above 5% and the 10-year slipping to 4.25%. And the US dollar has regained lost ground against the yen, with the Japanese currency having jumped on heightened expectations that the Bank of Japan could shift away from its negative interest rate policy. The British pound rose after another record month of British wage growth put the Bank of England on track to raise interest rates again. Average weekly earnings growth in the 3 months to July rose to 8.5% in annual terms. And the Aussie dollar is trading at 64.3 US cents. Well, over the course of COVID, active management gave way to passive as markets rose on the back of cheap money. But that trend has been turned on its head now. To discuss why active management is making a comeback, I spoke to Tim Richardson from Pengana Capital Group.
In the years running up to COVID, we saw investment returns very much driven by central banks' monetary policy. When money was free, pretty much everything in the share market was going up. Everything moved up together. And that was obviously a pretty nice environment for investors. But in that period, investors were getting the market return regardless of what they were investing in. So that was perhaps a driver for moving into passive management. We saw that over a number of years because everything was going up, everything was correlated. There was very little dispersion in returns. Even zombie companies that with very low operating earnings were able to move up. And so people thought, well, I'm getting the market return. Why pay for investment judgment?
So it was an easy ride, essentially.
Very much so, yeah. But now what we've seen, of course, is interest rates in the aftermath of COVID have come right up, and money costs something now, and that's changed the game entirely. And what was quite interesting is the future fund, which a number of years ago moved entirely away from active management, has now decided to allocate a significant portion of their assets to active managers. I think what's driving that, and there's a wider trend towards active in the broader investment markets, is there's a recognition that the easy money's been made now, and things are going to be a lot more challenging in the markets. For example, inflation is moving up, interest rates are moving up, deglobalisation is having a big effect on the markets. Government policy is much more important than it perhaps has been in the past in terms of the re-regulation of the economy and populist measures. What that means is that will impact markets, sectors, industries and individual stocks in quite different ways. So you're starting to see a much wider dispersion in the returns of companies in the markets. And in particular, during the rally that we saw in the first part of this year, so at a market level, the returns were pretty good, but they were very concentrated on a pretty limited number of stocks. So that's the sort of environment that a skilled investment manager can add value.
So you talk about that dispersion in returns. Is that likely to continue then, in your view?
I think that's pretty fair to say. What a real cost of money means is that balance sheets have become important again, and investors need to really look quite closely at those. If you look at companies that have got a sensible level of debt, perhaps with a fairly lengthy maturity profile, and also they've got the free cash flow that enables them to finance new investment projects, refinance their debt on attractive terms. Those sorts of businesses are probably quite well poised, but it's not necessarily easy to identify those at first glance. And also, if you're looking at the broader economic themes, what you're seeing is that companies whose business models are well aligned to those big global secular growth trends that we're seeing, such as AI innovation, the onshoring of manufacturing, decarbonisation, return to air travel, the ageing population and pharmaceutical development, all those sorts of long-term thematics present opportunities to companies to outperform compared to those businesses that are very much dependent on the course of the consumer spending cycle, which is likely to see a bit more of a rocky road during the high interest environment. And also with with deglobalization, that won't impact all businesses, all stocks in the same way. So those businesses that have got secure supply chains, that have got good access to their critical components and dependable, predictable access to their key markets, they're in a much better position to outperform. All of these factors work better with a bit of human judgment applied to them.
So from an investor point of view then, does that mean you need to be exposed to not just domestic but internationally to get that full scope? And what trends are you seeing there in terms of active management that those investors that want that exposure on international stocks?
That's a very good point. Accessing those secular growth themes, which is probably where the good returns are likely to be made over the next few years, is certainly a lot easier to do with an exposure to global equities. Australia's got a great market and some great companies in terms of things like mineral resources, banking, real estate, and energy. But it's the Australian share market is very, very much concentrated on those sectors. So if you want to access those global themes, an international equity exposure probably works pretty well. And for the same reasons, you're starting to see a bit of a shift towards active management overseas as well.
Yeah, I guess a case in point there is what we've seen with AI, that thematic that's developed this year, and you're not going to get that. Well, it's very limited here, isn't it?
Exactly,
simply because the tech sector is so minimal.
That's
Whereas
correct.
Obviously you're going to get that with exposure, particularly in the States.
Very, very, very much so. The taxation and the skill base mean that those sorts of business either start in the States or migrate there in a relatively early stage. It's more easy to raise finance and so on and so forth. But it's interesting that you raise AI, because this this kind of illustrates the opportunity for active management. However insightful a portfolio may be positioned on day one, a set and forget investment strategy does have quite severe limitations. So our Pengana Axiom International Ethical Fund had a position in NVIDIA, the semiconductor developer, which has obviously been a great story. Now that clearly saw some great share price appreciation, but by continually analysing forward-looking data points, our managers were able to recognise that the eventual size of that market and the margins that company was able to secure, given the competitive nature of that industry with pretty limited participants, suggested that the stock was much more attractively valued than the market did. That led the managers to continue buying the stock as it appreciated, and that clearly worked out quite well. So that sort of approach does have advantages.
Well, that certainly applies to those large cap stocks, as we've seen. You mentioned, for instance, a company like NVIDIA. What though at the other end of the spectrum there, Tim, with the small caps? Are we seeing active management there, and is that becoming more attractive?
Yeah, it's interesting you raise the smaller caps angle. The Future Fund has, for similar sorts of reasons, has decided to increase its allocation to smaller caps. With smaller caps, that's an opportunity to access future growth that larger institutional investors have likely overlooked. With the smaller cap markets are by their nature less efficient. 98% of companies up to $3 billion in market cap do not have any institutional analysts following them at all. So what that means, of course, is that the information flow is lower, and it's the market lacks that perfect information that the textbook tells us is required for efficient markets. That creates opportunities for active management.
Now, Tim, of course, active management by its very nature means higher fees because you're paying someone to actually do that job for you. What sort of consideration do you need to have there?
I think when you look at this question, it's a good idea not to get theological about it. The investment market needs both active management and passive management. Passive management brings a fee anchor, which benefits all investors indirectly, and active management brings price discovery that all investors benefit from. I think that's the first thing. The key thing for an investor that's looking at an active management strategy is to get very clear about what they're getting. Are they paying active fees and getting the returns of the market? Are they getting factor investing, which can be great, but you can pay a computer to do that more cheaply probably than a human being? Or are you genuinely getting investment expertise and judgment? And in these sorts of markets with higher interest rates and more variable interest rates, those are the investment markets that genuinely skilled investment managers can outperform, and that's why you pay a bit of a premium over a passive fund for active management.
Tim Richardson from Pengana Capital Group. That is the global view for this Wednesday. Let's check where we're likely to open in just a couple of minutes' time. You can see SPI futures off around 0.3%. Stay with us. The open is just around the corner.